one and all. I have the distinct honor and pleasure to interview Bob Coleman, who goes by Profits Plus over on the X platform. He's the owner of Idaho Armored Vaults, and he is also a precious metal analyst. I want to thank you, Bob, for joining us here today. You put out a challenge about manipulation. I wanted to discuss it with some folks in the community. And I was honored to have you agree to come here to discuss it. And before we get into it, I want to kind of give you, for your benefit, and for those of you who may be new to this channel, give you an idea of what I think manipulation is, because it's a very broad term. You know, before we came on, we talked about how it can be interpreted as manipulation or really management. We'll get into that later, but I look at it as two different distinct things. Manipulation in general, I believe, is when prices are managed or moved to the up or downside, much as what we saw with JP Morgan. And there's been well documented that the case there with they were penalized with the precious metals trading desk. They all got punished for it. I've covered it on my channel ad nauseum when that case was active and alive. But that was manipulation for selfish gain. In other words, the selfish gain of the individuals involved who moved the prices of gold, silver, platinum, and palladium up or down so that they could profit with high-frequency trade and what's known as spoofing the market. So there's that, which has been documented and proven. Then there's a conspiracy theory, and I'm becoming more open-minded to it now more than ever before, and this is why I wanted to talk to you about price suppression, manipulation to the downside, which many people feel that the big bullion banks, and I've learned fairly recently that the vast majority of the managed money in those ETFs are by the big bullion banks, which JP Morgan is the biggest owner, but there's others as well, that they're working to suppress the price of silver because of the high gold to silver ratio is one evidence of it. And they're trying to do it because they know how important silver really is for military, industrial complex, and all these other uses. It's in their best interest. So they're working collectively for something greater than their own self-interest to keep the price of silver down. I'm becoming open-minded to it, but I pushed back against that for years because I've not seen solid evidence of it. So I wanted to talk to you about that in particular, and also about management of the silver markets. So again, thank you. That's my introduction to it, and I'll let you go at it. What do you think about that?
Sure. Well, appreciate you having me on. And yeah, I definitely wanted to kind of throw out there an invitation to anyone that wants to discuss this. I think it's an important topic. It's really a rudimentary type of sales tool done by the retail promoter dealer industry a lot to get people to sort of be very, worried about the system, whether it's controlled, manipulated, whatever, and then get them obviously off the couch to buy metals from them. It's a really broad topic in terms of manipulation and management. Manipulation, I think, I look at this more as when you're really discussing the price action of, these 2:00 in the morning sell-offs that happen. We used to see these a lot back in the 2010s, where you'd have just an avalanche of selling that comes in, or a spike up in price. You could have it go either way. A lot of people were saying, hey, wait a second, that's, a big bullion bank coming in, wiping out the market and trying to artificially suppress the price down for, some type of stated goal, whether it's, to show the dollar stronger relative to the metals, or if it's to provide confidence into the system, whatever it may be. The problem with that narrative is that if you look at gold, it's gone up tenfold since 2000. This manipulation argument, yes, you could look at gold from a relative standpoint to money supply and to debt and so forth. And yes, the matrix and all the calculations are, very, very skewed at the moment, where gold could certainly go higher. But to say that there's sort of a big brother sort of, constantly having their foot on the neck of the precious metals world, I think they've done a very, very poor job over time, trying to manipulate the markets. I think the problem that we tend to see is the education of our industry could be a lot better. trying to define these terms a little bit more, because when you talked about the JP Morgan case, for example, that from 2008 to 2016, multiple cases of basically what you called spoofing, where they're trying to show a bid or an offer in order to push the price in a direction to maybe execute a transaction, with no intention of actually, when they place a bid or an offer, to actually go through with that side of the transaction. Yes, that's spoofing, and that was definitely prosecuted, and the parties were found guilty. What is very difficult is this overall theme of conspiracy of manipulation of the silver price by an entity or a group of banks over a stated period of time. That's much harder to define. It's harder to define from a standpoint of intent, which is really the hardest thing to prove in a court of law when you're talking about manipulation. It's one thing to, like you said, spoofing the price, and you're spoofing it either to the upside or downside. That's fairly straightforward. You look at price order books and so forth. You can pull all this data. The CFTC can get all this type of information. To turn those price books and computer logs and so forth into and try and find intent, that's a different story altogether. Does that kind of help a little bit?
Yes, and I guess that's the point. Intent being suppression. There's the two things. We know the spoofing was selfish gain for the individuals involved, but the intent to suppress by the big bullion banks, harder to define, harder to calculate. But many people in this space, and again, I pushed back against it for a long time. I'm more open-minded, but I still have not seen actual evidence of suppression. And I wanted to get your thoughts on that, on actual price suppression by a conglomeration or a conspiracy of the big banks.
Yes, I think you have to take a step back if your audience can kind of envision, when you're dealing with the precious metals world, you're dealing with physical metals, you're dealing with derivatives, you're dealing with options, futures, structured products, forward contracts, swaps, a whole different type of industry. I mean, it's a very, very broad industry. So there's multiple players doing multiple things all at the same time that's impacting that price action. And in New York, we have what we call the COMEX, which is our futures market, and players that are involved with that market traditionally use the futures market as a hedging market, or it's a seller's market, meaning if a bank, for example, and just to let your audience know, the biggest buyers of metal, especially earlier this year, were actually the banks. They bought an enormous amount of gold and silver. And what they did was they put that metal onto the exchange, and they sold futures contracts against that existing inventory position or physical position. But just to go back to the purpose of the COMEX, it traditional sense is the futures markets are a hedging mechanism. Whether you're a farmer that wants to hedge their corn crop or another type of commodity, they use that to try to neutralize price risk. And so what you tend to have happen is London, which is really the physical metals capital of the world, deals more with the spot price or the physical metal most of the time. And what those players do is they buy the physical and they go over to New York and they short the futures contract, and that locks them into what they call a certain kind of spread, and that spread is called the exchange for physical. That's the difference between the spot price and a higher futures price, because right now we're in a contango, so the futures price is higher than the spot price, and so they make money on that spread. The problem, though, is it tends to add selling into the market, which most people, which may not be aware of, is sellers that actually have an underlying physical position. And this is something that the retail dealer promoter sort of community that really tries to espouse this manipulation argument doesn't really do a great job of explaining. Because if they actually went into this a little bit more in detail, they'd realize that a lot of the industry, they're really trading on leverage and they're really trading the spread. So not trading maybe a secular position going to a certain direction in price. They're really just trying to lock in and pick up pennies on the dollar and just do it over and over and over again. Now, you also have in London, for example, you have the ETFs, and the ETFs have really spawned into an enormous industry, especially in the commodities world. You have SLV and GLD, which are the biggest ETFs. Well, the way the ETFs work, they hire authorized participants, and those authorized participants provide liquidity to the ETFs. They will buy and deliver metal to the ETF and receive shares back and sell those shares into the market. Or they can buy shares in the open market, for example, and redeem those shares for the physical metal. And they do this on a day-to-day basis, constant moving of shares and metal back and forth between the ETF because they're providing liquidity to that ETF. So when you or I want to sell SLV shares, we can sell those shares into the market, and the market maker can say, okay, well, if those shares are at a discount, I'll buy those shares. The shares are at a discount to NAV. I'll buy the shares, deliver those shares to the fund, and in return, that fund is going to give me metal back. So I can actually make a profit by buying cheaper shares than the underlying metal itself, and then actually getting the metal back. And then that's a spread or a profit that they make money from. And what most people don't understand is people invest in the ETF thinking the ETF is the product. Well, in essence, really the ETF, in the ETF world, the investor is the product. The market makers make money on the flow of capital that goes in and out of these ETFs. And that's just a small microcosm of the precious metals world. You get into forward contracts, you get into spot forwards, obviously with the futures markets and the tariff situation that happened earlier this year. You have one of the reasons why you had such a swell of inventory coming into the COMEX earlier this year was if you're a foreign investor, for example, and you're hedging your physical position in London, for example, and the bars that you have in London happen to be Royal Canadian Mint bars, for example. Earlier this year, Trump was threatening a tariff, saying, listen, if you bring those bars into the country, we're going to tariff you potentially 25% or 50%, whatever the number is. Well, all of a sudden, that tariff is something you cannot hedge. And if you wanted to settle that contract, that futures contract, that short position that you had against your underlying position, and let's say you had $1 million in metal, you'd have to cough up another $250,000 just to pay the customs fees to get that product into the country, which would wipe out any profit and send you into a severe loss. And so what happened was people were rushing to take any kind of metal that they had and deliver it into the U.S. to avoid that sort of deadline when tariffs were maybe going to start occurring. And that again, that was a lot of banks buying a lot of metal, especially from U.S. refiners, but bringing it in just absolute waves. And so, again, that's not talked about in the retail dealer world or the promoter world, so to speak, or social media world. They're trying to say, listen, China and India are buying all this metal, which they are. They're big buyers of metal. And they left out the bank portion, which has been one of the biggest buyers, especially here in the U.S. Because you have to look at it. This year, retail, as well as last year, retail activity in precious metals have been sharply diminished from the prior few years. You've had up until maybe the end of summer here. It's been there's been waves of selling by retail investors taking that metal, saying, hey, listen, I don't. I'm happy with the price where it is, or I'm worried that it's going to come crashing back down. They believe this manipulation narrative, and they end up selling and never getting back in as the prices are working their way higher. So in a way, some of this manipulative narrative that the retail dealers have been selling to the public is now backfiring because they got people so worried that the price is going to get smashed right back down. They're wanting to capture the gain as fast as they can.
Yeah, it's tough. And I mean, I want to be as open-minded as I can to it because I always hear, well, they're all shorting the market. They're shorting it. And of course, I covered in a topic in a video that I did maybe a month or so ago that those positions have now changed to the long. And so we're starting to see that shift. But one of their biggest arguments is that they're all shorting the market for silver. And that's why the price is so low and the gold to silver ratio is so high. But of course, as you mentioned, there's a lot of complexity, there's a lot of moving parts within the silver market. Of course, as you alluded to earlier, you look at these overnight high frequency trades, these smackdowns in prices are at 2 a.m. and the Friday smackdown, there's an X account called Mr. Slammy. And he's like, okay, Mr. Slammy's coming back. It's Friday. We're ready to make it happen. So this coordinated selling is what they're talking about. And when you're talking about it is mainly in the paper markets. As we know, the ETFs, I like to think of them as not buying silver, but exposure to silver's price. Not actually buying the physical. But that. So I'll leave you with that as far as this topic here. What's your answer to the argument that they're coordinated selling and they're shorting the market to keep the price low?
Yeah, you have to remember the futures markets, when you get into these sort of illiquid times of the night, you have to remember Asia is actually trading during daytime hours at that point. And so what you tend to have happen is, and I'm not saying this is just straight, Asian selling that's coming in, taking out the bid, and then you have to remember there's a lot of orders that are stacked in sort of the market book or the futures books with clearing members, and so they have what they call, it's very common to put stop orders in. Let's say you own gold at $3,000 an ounce, and you're saying as a trader, because you have to remember when you're watching the futures price, you're watching a leveraged product being traded. It's not a leveraged security. It's not just, you and I buying 100 ounces of silver in cash where, we're not as worried when the price goes up or down 50 cents. When you're dealing with 10-to-1 leverage, for example, yes, that 50 cents can have a much broader impact on what they call a margin call. So what happens is, when that selling comes into the market, it can be anybody. It could be any market participant. It could be an institution that's wanting to build a position that goes in and starts selling the market down, knowing that if they can hit enough sell stops, they'll force a sort of a mini avalanche of selling that they can then sit on the bid and start buying and building their position. In fact, we saw that sort of happen in April when you had this big drawdown in silver from $34, I think, or $35 down to 28.5 in a very, very quick period of time. There was actually some very prominent players that were coming into the market buying on that big pullback. And sometimes, it could be market makers that are watching the markets. They see the order books. They could easily create, for their client base that wants to get in, they can create that volatility in order to work an order, for example, to build that position for their client. Now, that may not be called manipulation. To the retail investor, that's like, well, that's unfair. But in essence, that's how Wall Street works. It's been that way since, since the market started trading, long time ago. You used to see this in the 1920s with the stock operators and so forth, where they would push the market around up or down. But that's part of that's why, to me, the whole system is managed. It's not just the metals markets. I know there's a lot of frustration out there, but you look at the treasury market, you look at currency markets, you look at the stock market. I mean, you look at the S&P 500, for example. The S&P 500 from 2020, or I'm sorry, from the year 2000 or 1971 to today, gold actually has outperformed the S&P 500 on a performance relative basis, not including the dividends. Whereas, and most of those companies that were in the S&P 500 back in 71 are no longer even in the index. Most of them are maybe out of business or bought out by another company. So, the S&P 500 is somewhat of a sort of managed index that you take the bad guys out and you add the good guys in, and you do that on a constant basis. That's one of the reasons why fund managers have underperformed the index over time, because that index is constantly changing. Well, that's just another form of sort of this market structure that, some people may call that manipulation, but it's just how it works.
You make a great point that almost every market is manipulated. And I think probably one of the biggest manipulators is the Federal Reserve itself. I did a video one time where the former Fed chair Janet Yellen said one word and it moved gold and silver prices crazy. It's there's a lot of psychology in the markets, and it's really boils down to just psychology. I think politics, psychology, it's just what it is, and it's all being managed by the power brokers. And I want to touch also about something you alluded to earlier as well. I am a precious metals channel on YouTube that has a bullion dealer as a sponsor. That's Summit Metals, and I want to be very careful. In fact, as part of my contract, I don't do hype. I try not to do hype as far as where the silver is going to go to $100 tomorrow or $1,000, and this is just the beginning. And I talk about what other people say, and I try to bring it in balance. I believe silver sells itself, so I want to be very self-aware with regards to that, to not oversell because I want my dealer to get orders in. So I want to be very careful about that. So, and I know that was one of your challenges. Of course, the manipulation narrative can move in that direction too, to get people to buy. So, but I'll let you respond to that, and any other closing thoughts that you have.
One of the issues that I see a lot is these channels, promoters, social influencers, and dealers kind of all in the mix supporting this. They create a narrative of $200 price of silver, and the client or the customer sees that $200 price. It's like sort of dollar signs in their eyes, and they don't think about what the cost of the metal may be, and so they're willing to pay and not really look at the actual premium that they're actually paying. And I saw a lot of this, I call manipulation and deceptive sales practices back in 2020 to 2023. A lot of hype, a lot of using the term shortages of silver out there, using that type of leading the client to a belief that the dealer wants the client to believe, not necessarily the reality of the situation. And so I explained to people back in 2020 to 2023, it wasn't a shortage of silver. It was just a tightness of product, because we were,
Right.
It's a totally different era back then with social distancing and manufacturing and so forth. And so what's happened is those clients from a lot of these big name dealers paid huge premiums. I mean, $2 to $5 more over spot than what I was charging. My business model is totally opposite of everybody else in the industry. So I'm more of an advisor versus more of a commission dealer, so to speak. So I work really more on the behalf of the customer. Definitely having dealers that do a great job of trying to keep prices down for people. That's great. I applaud it. There's a lot of great local mom and pop shops and local dealers that have just a vast knowledge of the markets, of the coinage, of the products that they're selling. But it's really taken on this. The larger organizations out there have really created this sort of marketing blitz that sort of it's more hype than it is, and you see it because their marketing budgets are much greater, and they can afford. The reason their marketing budgets are so much greater and they have a much louder voice is that they charge much higher premiums. Whereas, and at the same time, they're telling everybody we're the lowest in the country. And I think that's something that the industry needs to clean up.
I agree, and I don't want to participate in that kind of hype and that kind of manipulation to that end. I want to be very sensitive to that. It's about being real about the markets. Like I said, gold and silver, they sell themselves, and I always tell folks, hey, if you're not buying, at least hold on to what you have. And there's a time to buy and a time not to buy. And I always tell folks, hey, I'm not buying at this price, this massive spike up in price right now. I'm going to wait and see what happens. Usually there's a motion that drives the price up, and there's a consolidation period, and that's when I'll step back in. And excellent advice and good words. Well, thank you so much. This has been very eye-opening. Time has flown by here. I'd love to have you back, and I appreciate you taking the time and to spend with me here to discuss this.
Sure, and just let your audience know a little bit about myself. Just a quick note. I do run a very, very large private depository. We have a $1 billion all-risk insurance policy. I run a hedge fund that's in precious metals as well. So, and I've been an investment advisor, registered investment advisor since 1993, or actually 1992. So I have a vast experience in the financial markets. Maybe that gives a little bit more color or meaning toward what I'm seeing versus, the other side of the equation, which is the retail dealer industry, which really isn't regulated and it's really not supervised, unfortunately. And that's where you see a lot of the dichotomy in terms of is it in the best interest, what they're saying, of the customer, or is it in the best interest of themselves?
Well, thank you for that perspective, and thank you for sharing your vast knowledge and experience in so many different areas as an investment advisor as well, and being so knowledgeable about the markets. If you want to follow Bob Coleman on X, like I do, go to Profits Plus or at Profits Plus ID. And Mr. Coleman, thank you again so much for spending your time with us here. And I want to extend a multitude of gratitude to all of you for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.